Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise listeners. Thank you again for jumping into yet another episode. I've got another amazing guest with me here today. I've got Aubrey Linville. Aubrey, welcome to the show.
Hey, thanks, Jeremy. Thanks for having me.
Yeah, absolutely. Looking forward to chopping it up with you. Just before I hit record, Aubrey and I were talking about where each other is from. Today, December 4th, I'm up in Minnesota. It's minus 10 degrees at my house this morning. Aubrey's out in a much warmer climate out there in North Carolina. And so we were just talking a little bit more about kind of, our own investing journey out there in North Carolina and how that state is just rocking it, right now from a job growth, wage growth perspective, population growth. And Aubrey is in the Winston-Salem area. Am I saying that correctly?
Yeah, Winston-Salem, North Carolina.
All right, wonderful. Great area to be in, great market. So Aubrey, I'd like for you to maybe let our listening audience know a little bit more about, yourself, your background, your focus, your journey. I know you've got decades of experience, in commercial real estate, across a number of different asset classes. So would love to learn a little bit more about your story.
Well, I'm 48 years old, been married for 26 years. I've got a 18-year-old girl and a 19-year-old boy. So, everything starts with my family. I think that's the most important investment I've ever made outside of all the real estate stuff we're going to talk about today. But I was born in Washington, D.C., right outside of D.C. in Silver Springs, Maryland, moved to Winston-Salem when I was in the fourth grade, never looked back, fell in love with North Carolina and the people and the culture here. I can remember being in the fourth grade and just people in North Carolina welcoming me with open arms. And that's really the spirit of the Carolinas and the Southeast, really. So just it's really a privilege to be living here. I think it's something that we take for granted a lot, how great this market actually is and the people are. But my story, I grew up in a very entrepreneurial family. My dad was a franchisee of putt-putt golf and games. He had somewhere around 25, 26 locations on the eastern part of the United States. Then he got into the family entertainment amusement park business, which is some small amusement parks. And while he was a business operator, the thing we talked about at the dinner table was the real estate. So that was kind of his thing. We talked a lot about demographics, and he didn't have access to demographic data like we do now at the click of a button. So they were having to hire consultants, and he was going out to the opposite corner and clicking a button of how many cars are coming by every day and paying attention to which way the traffic was turning and where the houses were being built. And those were things that just really had an impact on me as a kid. Also, just his tireless work ethic, him and my mother instilled that in me and my two siblings. I have two older sisters. So that entrepreneurial thing has just, part of my DNA from day one with my father. So I graduated from North Carolina State, started a small business while I was there with a good friend of mine. It was a junior golf business. I had no business being in the golf business, but we were onto something. It worked out pretty well. And that turned into a clothing line for kids golf, and that turned into an e-commerce business for kids golf. And then I was probably 26 or 27 and had a small exit selling the business, and was trying to figure out, what's next for me. And it wasn't going to get what at the time I would have called a real job. And so I started investigating buying foreclosures. That was like a hot thing that was, on the infomercials late at night on TV. And Carlton Sheets was like the big infomercial guy at the time. I never subscribed to any of his things, but I just, got an interest in it. And I started flipping houses at the courthouse. That led to, a couple hundred flips, had done some small apartment complexes, some small office buildings. And right as the great financial crisis was coming, and GFC was here, I was flipping 41 houses, and I was in a pretty tough spot. I was trying to figure out, how do I not go bankrupt? And so I ended up renting all those properties and got into real estate brokerage. I was offered a job by one of my greatest mentors, other than my parents, a guy named John Ruffin at Meridian Realty Group. They brought me in, and we started a special asset services kind of program there, helping the regional banks figure out what to do with all of these assets that they were bringing back. So they would hire us to go out and do a drive by, an opinion of value. What's some of the hairballs that they're going to encounter if they bring this thing back, and ultimately, if they did bring it back, they hired us to sell it. And during the GFC, that was really the only thing that was selling. So that was my first entry into real estate brokerage. And then from there, after about 4.5 years there, a guy by the name of Coleman Team, 10 years younger than me, but also a great mentor of mine. He was 30, he was 23 or 24, and I was 33 or 34. We started this company, Linville Team Partners. It was Aubrey Linville and a guy named Coleman Team, and the two of us as partners. And we thought it would be him and I, and we would do some brokerage and some principal related activities. And it just grew organically to what it is today. And so to bring it full speed to where we are now, we're a brokerage company. We have 4 distinct business units here. We have a brokerage services division where we help buyers and sellers and landlords and tenants with whatever their commercial real estate needs are. We don't do any residential unless it's multifamily. And we have an investment platform, which I know we're going to talk a bit about today, where we buy assets and we syndicate those, or it's through our fund. We have a property management division where we only manage properties that we own. And then we have a 4th business unit we refer to as Expand, where we do buy-side M&A advisory for retailers.
It's great. Well, that's quite the background. It's quite remarkable. And I was, thinking about kind of your, early days, your childhood days with your, dad, getting involved in, or your family really getting involved in a putt-putt business and a later amusement park. And I can't think of a better, really a better thing for your parents to be involved with, when you're a child, right? And so appreciate, you kind of sharing that, as well as, kind of your, journey, into the commercial, real estate space, or real estate space in general, back during the global financial crisis. You and I are about the same age, and that's about the same time that I also, cut my teeth, in the real estate space, which was a tremendous time, when there was a lot of blood on the streets and valuations were down. And, my wife and I just happened to have some extra dry powder, sitting on the sidelines. And so we started to deploy capital, into real estate, projects as well. And that's kind of how we, originally got started in the space. But would love to hear maybe a little bit more about, I know you've had experience and involvement in a number, different asset classes across retail, office, multifamily. I'm a limited partner, passive investor in, 7 or 8 different, asset classes myself. So we'd love to learn a little bit more about, kind of which specific asset classes you tend to focus on, maybe you find, to be, more up your kind of alley, versus maybe others that aren't necessarily in favor right now.
Yeah. I will tell you kind of what our buy box looks like for our fund. I have bought and sold across almost every asset type and asset class. A plus retail properties, D minus industrial properties, single family residential in a really, really bad part of town that I bought for 15,000 and fixed it up and sold it for 40. And then, $280,000 house that you put 100,000 into and you sold it for 500,000. So like I've kind of seen a little bit of everything. And what we're most focused on right now are North Carolina, South Carolina, and Virginia for starters. We're really bullish on these markets. A lot of people moving here. There's a lot of retail growth happening here, job creation happening here. So that's kind of the tip of the spear, right? So we're geographical focus in these 3 states. And then beyond that, it's where we can find opportunistic buys. We're not the 6 cap, A plus plus buyer right now. We think we can bring the most value for our investors finding things that have just, a little bit of hair on them. It might be a retail shopping center that has a large lease that's coming up in a year and we know they're not going to renew. So we might buy a shopping center and say, we got a year to figure out what are we going to do with this tenant. Or we bought a shopping center that has a bunch of full service leases in it. But a lot of those leases are rolling. So what we're going to do with the full service leases is convert them to triple net leases. And over the hold of this asset of 7 years, we're going to position it for a sale. We were able to buy it at a pretty steep discount because of these little hairballs that are associated with it. So I would say, we really like retail, service oriented retail. We really like industrial. And I'll be honest with you, I'm starting to get a bit more bullish on office. This global economy was built on people working in an office. And right before COVID, everyone was trying to build, the baddest looking office, the most modern office, the coolest place, the hippest place, like a place where you could create a lot of culture. People really enjoyed coming to work and got energy out of walking through the front door, which I think we have at Linville Team Partners. I turned my camera around to show you our office, but I'm in a different part of the building that I couldn't show that off to you. But we're really proud of the energy when you walk in our front door. And I think about where office is now. We've had all these people work remote. They're going to come back. It's just a matter of when. So there's opportunities out there where there's half vacant office buildings where you can buy it based on in-place NOI today. And then the upside's pretty easy to quantify. So get the building at a steep discount based on today's NOI. And worst case scenario, you don't ever lease any of it up and you preserve the tenants that are in the building. Reasonable scenario is you do a pretty good job getting the building leased up, and you increase the NOI and you end up with an asset that's worth a lot more when we go to sell it because cap rates have come down on office and tenancy's improved. So retail, industrial, and office, I would say, are kind of in that order of what we're most focused on.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Couldn't agree with you more, especially on your sentiment about, when investors seem to be, not so bullish on a specific asset class. That's usually the indicator, at least from my crystal ball perspective, that's usually the time to really get involved in that asset class when it's really fallen out of favor with investors, on a larger scale. We saw that happen, in the multifamily space, back in 21 and 22, cap rates were compressing and rents were going through the roof. And everybody was making money. Even bad operators, looked like good operators because they were producing, outsized returns, for their investors during that time period. But then, of course, the rug kind of got pulled out from under them, because of a couple of things. Obviously, the historic run up in interest rates caught a lot of operators off guard, but also you had a glut of new supply, hitting, different markets around the United States. And of course, that supply, demand imbalance, created an unfavorable environment, within multifamily. But then now in the last, 36 months, multifamily, office, retail, et cetera, we've really largely seen kind of a downturn from a valuations perspective, in those asset classes. And I feel very strongly, and I'm sure you do, and I'd like to hear your opinion on this as well. But I'm very bullish, on all three of those asset classes myself as well, because the truth is that you're right. The home shore thing, certainly worked for a little bit of time, but getting people back into the office and that culture, that ability to kind of hold each other accountable, create that team type environment, within your, organization, whatever industry you happen to be in, is never going to really go away, right? And the same can be true really in the multifamily space, with the average, age of a first-time home buyer now hitting 40 years of age this year. It's just out of touch for a lot of, our younger population and demographic to be able to afford, a single family home. So they need to generally navigate towards, that multifamily space. So again, would love to maybe hear a little bit more of your perspective on kind of what I said there.
Yeah, I mean, I tell you one thing that we pay a lot of attention to are buying assets in these markets that were built and leased when construction costs were a lot lower. So if you think about, if you go buy an office building today that was built in, say, the 90s or the 2000s, the rents in these buildings, depending on what market you're in, where we are, if you buy a building that was built in the 90s, the rents were probably at, let's talk about retail, for example. The rents are probably in that like $15 to $20 range, right? For the middle, maybe not the anchor, but the small shop and middle sized box spaces. But you build that today, those people are going to be paying, mid 30s in our market. So you find a shopping center, a multi-tenant shopping center, you can spread your risk across a lot of different tenants. So you don't have one pull out and then you're in a cash crunch, right? Something that was built in the 2000s, people are paying, $18, $20 a foot, triple net. You get some leases that are rolling over your 5 to 7 year hold period. If you can increase those somewhere closer to what today's rents are, immediate value appreciation in that asset, right? So you're taking advantage of older construction costs. But yeah, but to your point, I mean, there's nuggets of gold in every asset class. I mean, there's even nuggets of gold today in these multifamily properties. There's properties that, areas that were overbuilt. There's developers or owners that haven't been able to sell. They're upside down. We don't play in the Class A multifamily market at all. Personally, if I was going to buy something, like there's not a play for our fund at all for multifamily, to be honest with you. But personally, if I saw like a 6 or 12 unit multifamily property that was built in our market or some tertiary market close to us where the rents were depressed, we could buy it based on NOI. That's something I'd be pretty excited about because, I know that people are moving to North Carolina, rents are going to increase and the value is going to increase commensurate with that rent. So I don't know if that hits exactly on your point, but just in general, I think you can find a reason to buy most asset types and most asset classes if you're a creative problem solver.
Yeah, no, that makes total sense. I agree. There's kind of this kind of balance between, organic appreciation and forced, value creation and forced appreciation. So, kind of pivoting back to this organic appreciation, which is largely, centered around inflationary pressures. We've seen organic, rent growth, within different asset classes, whether it be retail, office, multifamily. We've really seen a lot of compression, happening, and even in some cases, even declining, organic rent growth, in certain asset classes and certain markets across the United States, even in North Carolina as well, as we're an investor there. Would love for you to maybe kind of talk a little bit more about, or maybe give your perspective on, inflation being a massive concern, or if you're not massively concerned about it, you ought to be, right? Especially what's happened over the course of the last 4 to 5 years with the value of the dollar, severely declining, and a lot of people's, net worths becoming much less, today as a direct result of what I call the inflation monster. But from your perspective, how does commercial real estate provide, for a hedge against inflation, and kind of your own, your own opinion?
Yeah, I'll answer your question, but quickly. You talk about inflation hitting people's wallets and it affecting commercial real estate. South Charlotte, which is one of the hottest, hippest markets for up and coming new restaurants and whatnot. I heard yesterday that there's over a dozen restaurants in South Charlotte quietly being marketed that are, as second gen restaurant spaces. So, all these cool restaurants that are coming to one of the hippest places where tons of young people are moving, they're struggling. But to answer your question about how you real estate as an inflation hedge, well, a lot of times properties appreciate at a faster rate than inflation. A great hedge against inflation for the landlord is if you're buying an absolute triple net lease or a shopping center that has triple net leases. A lot of the costs that are affected by inflation are passed on to the tenants. Now it's kind of like chicken or egg deal. You've got the tenants that could have trouble paying rent, like these restaurants. If people aren't coming in there with money in their wallet to spend at your tenant's establishment, they're going to have trouble paying their rent. So, I mean, it's just the life cycle of the whole inflation issue can touch on a lot of different points. But we think of fixed debt as a way to hedge against inflation. If you can pencil a deal today, at 6.5% interest rate is kind of what we're seeing on deals that we're buying. It's come down a decent bit over the last 6 to 9 months. We think it's going to come down a little bit more. Banks are getting more competitive, wanting to deploy capital. But this inflation thing, that's a great way to hedge against inflation, right? If you can lock in fixed debt for 7 years, 10 years, if you're lucky, that's a great way to kind of just ride that wave and see what happens for the next 7 to 10 years. And then the way we mitigate the inflation risk is really, we're not buying a lot of full service or modified gross deals. We're really looking for the net lease deals that are out there where we can pass along those costs to our tenants.
That makes total sense. And I would assume that most of our listening audience understands the impact of inflationary pressures, and eventually, those inflationary pressures end up in the cost of goods, services, wages, valuations of hard assets, those types of things. I'd like to maybe kind of pivot, here and talk a little bit more about kind of, what builds trust fastest with investors, what breaks it instantly. I know you've, built trust with over, 100 different accredited investors in a short period of time. I personally, serve over 500, investors myself, that I've supported, over my time period, raising capital, into our real estate projects. So would love to maybe kind of get your, sense on, what builds trust with people.
I can tell you this, it doesn't happen overnight. I think everybody knows that, right? Like your reputation is all you have. I don't care what business you're in a relationship business. And whether or not, of 100 accredited investors we may have today, 25, 30% of those people, maybe I didn't know 6 months ago, but they were connected somehow to somebody that I did know. And those people were willing to give either a warm introduction or vouch for us, our company. But our company is built on trust and reputation. There's a lot of people that are doing what we're doing, Jeremy, but there's not as many people that do it with trust and integrity, and they're ethical or moral and treat people the way that they want to be treated. So I think the quickest way to build trust is to learn that at a young age and know that business is a marathon. There's no quick hit in any business. If there is a quick hit, it's going to be a quick fizzle at some point. And so we just spend a lot of time, emphasizing relationships with everybody, whether it's somebody we don't know walking down the street, that, walking by our building, looking at it, we might walk outside and say, "Hey, are you trying to find somebody?" And build a relation. You just spend your entire life. I'm a high EQ person, so my emotional intelligence is high. I thrive on relationships. I'm an extrovert. So I get a lot out of building these relationships and just being a connector. And because of that, you just build trust organically. And, it's just not something you can force. And the quickest way to lose it is to not be honest with somebody. That word travels faster than the good word. I tell my kids all the time, you're the average of your 5 closest friends. So surround yourself with great people who lift you up, who carry themselves the same way that you carry yourself, and treat people the way you want to be treated, and things will work out. I tell my kids, all you really need in life is a great smile, a great reputation, and a strong work ethic, and everything will come into place. So that's kind of our MO.
Yeah. Well, listening audience, hit the rewind button here. Listen to the last 90 seconds again. This is the best part of the podcast episode. And I couldn't agree with you, more, Aubrey, in terms of your, definition, or how you would kind of define, building up and retaining, trust with somebody. I tell my own kids, you build up trust, one drop at a time with somebody, but you can lose it, very quickly in a bucket full, right? And for me personally, my kind of definition of, building trust is really around, being genuine, being authentic, and being transparent, with people. And I think in that, that's how I can very quickly build trust with somebody. But I'm a lot like you. A lot of our investors, come to us as a direct, because of referrals, right? Because they're basically leveraging the trust of somebody else that they have in us, right, to choose to deploy capital into one of our, investment projects. So really appreciate you kind of sharing that. I'd like for you to maybe kind of give your perspective on this one final thing as we kind of wrap up, and that is, what's maybe one big mistake that you see, first time commercial real estate investors making, and how do you kind of coach them to avoid, that pitfall?
Sure. So this would be an investor who's not necessarily investing alongside us, but maybe a friend who's thinking about considering a deal and they're asking me for advice.
That's right.
Okay. I would say always plan for the worst. I mean, I think that the easiest thing to do when you're considering investing in real estate is get excited, and you build a pro forma around best case scenario. Because maybe you're naive and you haven't done it yet, and you don't realize how hard this work is. Maybe you haven't ever hired a contractor and seen things go over budget or over schedule. Or maybe you just don't know how much these things cost, or how long it's going to take to get a tenant in there. I mean, a lot of times you see like a fourplex. A friend of mine's come to me with a fourplex before, and he's shown me his pro forma. Say, okay, well, you've got 25% vacancy credit loss for a tenant every 24 months or every 12 months. Well, what about the fix up costs? That's going to eat you alive. Replacing the carpet, the countertops, the refrigerator when it goes broken. Like, where is all that in here? They're like, oh, we'll steam clean it on our own, or we'll paint it ourselves. Or that works for a little while, but it doesn't work forever. And so I would say just being really conservative in your underwriting model. I mean, Nick Gonzalez, my business partner, is one of the greatest underwriters I know. He thinks, he turns over every rock and understands every, potential hidden gotcha that's there. And we underwrite to that. A lot of times sellers don't necessarily appreciate that, but, our investors certainly do. I can promise you that. And I think as I'm talking to new investors, it's understand the product type that you're thinking about investing in. Know everything about that fourplex in this neighborhood and every other fourplex in the neighborhood. Talk to people that have bought these other fourplexes. Talk to a lot of people. Make sure you're learning some real life experiences somewhere other than YouTube or from this Carlton Sheets. These kind of people that are on these infomercials that are telling you things, because it's not easy. Investing in real estate is not an easy button to wealth. It definitely, I've had some great investments. I've had some not so great investments. And through all that, I think we've ended up with a really deep skill set here that is valuable to our investors. And that's part of our pitch. We've been there and we've done that. And we understand what's around most corners.
That makes total sense. And Aubrey, I really appreciated the tremendous value that you've brought our listening audience today. What might be one or two different ways that we can connect with you to learn more about what you're up to offline?
Yeah, sure. Love to share our website, LTP for Linville Team Partners, so ltpcommercial.com. There's some great information there about our company. You can learn more about our investment platform. If you're interested in investing with us, would love to talk to you on the phone. If you're somewhere close, or maybe I'm traveling to where you are, I'd love to meet in person, have coffee, lunch, dinner, whatever that might be. There's a really easy way to investors to register on our website. If just first name, last name, and email address, you'll find out. You'll be on what I would call our short list. You'll be finding out about all the deals that we invest in, whether you decide to invest or not. It's just a great way to be in the know. And then my email address is aubrey@ltpcommercial.com. And the phone number here is 336-724-1715. I'd love to be a resource for you or any of your listeners as they're considering potentially an investment in the Carolinas or a move to the Carolinas even.
Yeah, that sounds good. Well, we'll put those links in the show notes for the episode. Aubrey, again, thanks again for joining us on the show.
Thanks, Jeremy. It's been fun.
Absolutely. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.